Well, welcome to the Monday Money Tip Podcast presented by Fully Funded Life. My name is Joe Sengel, and I'm committed to helping you win with your money so you can indeed live your fully funded life. Today, we're going to talk about a topic that hasn't been relevant for approximately 2 decades, but it has become wildly relevant now, and that is about CDs, certificates of deposit, that actually pay interest, like 5% interest or greater. That has been a long time since we've been able to say that. I'm going to specifically explain a structure of how you can use CDs through something called CD ladders. So if we're giving this a title, CD Ladders Explained. That's what we're going to call it. You know, we talk about the Fully Funded Life ladder around here a lot. And when you think about CD ladders, this is for saved money. This is not investment grade money. You know, investments where you take risk. And we talk around here about 5-year windows. If you think you don't need the money in the next 5 years, yeah, that probably should be invested in something beyond CDs. But for that money that you have saved, for that money that you need in the next 5 years, that saved stuff, that emergency fund, rung number 2 is that 1 month's worth of expenses saved up. That rung number 5 is at least a minimum of 3 months worth of expenses saved up. Well, then CD ladders can be a great thing for you. You may be saying, what is a CD ladder? Well, I got good news. I have an explanation. Let me show you some pictures. This is really good for you to watch if you're going to watch it on YouTube or on Facebook or somewhere or anywhere that this is available. But I'm going to try to explain it if you're listening to it while you're on the treadmill or driving. So let's say that you want to put your money in CDs, that you want to lock it up. Well, a CD is where you lock up your money for a specific term. In other words, you lose some liquidity of your money. So if you put money into a 1-year CD, you have to leave it there for a year. If not, there's a penalty in which you forfeit a quarter's worth of interest, maybe more, because the bank needs guaranteed that the money will stay there, because in turn, they will pay you a higher amount of interest, and they want the guarantee. The reason they're willing to pay the higher amount of interest is that they have guarantees that that money can be lent out to someone else where they're going to charge 9 or 10%, and they make money on the spread. So that's how banking works at a very base level. But let's say that you had $4,000 that you were going to invest, and you wanted to be able to access money, though, every year or so. Well, a CD ladder is the perfect structure for that. In this example, you can see that we had $4,000 to invest, and with that, we bought a $1,000 CD for a 12-month term. We did another one at 2 months, or 2 years, 24 months. Another one, a 3-year one, a 36-month one, and another one, a 4-year one. It's a 48-month term. And you got different interest rates. So for the 1-year one, you got 5.15%. At 24 months, you got 5.35%. At 36 months, 5.5%. And that 4-year or 48-month one was 5.4%. The reason you structure it this way is so that every year, a quarter of your money is freed up for you to make a new decision with. After 1 year passes and you've had that guaranteed 5.15% for your 12-month one, of course, your 2-year one is at 5.35%. It's earning that rate for another year. You get to that moment, and all of a sudden you ask the question, do I need this money, or do I roll it into a new CD? Well, let's say you didn't need the money. Well, then in this CD ladder, you would roll it over to a 4-year CD, which would now stretch out in our timeline to year number 5, because you've already had a year go by. And let's say you're able to get 5.4%. Well, 1 year later at the 24-month mark, your 2-year CD is now up, it's expiring, and you can ask the question, do I need to use the money for something else, or do I roll it over? If you roll it over, it's another 4-year CD, and let's say you got 4.9%. The rates had decreased. And so now that reaches all the way out to 6 years from our starting date, right? We've expired 2 years. We got another 4-year note. It's 72 months. And so on and so forth, that every year you have the opportunity to review your money and make another decision with it. I hope that makes sense. If not, replay the video for the last 2 minutes and you'll see it again. Now, some advantages of CD ladders are, one, you get guaranteed interest rates. That's a big deal. Guaranteed interest rates. You know what your rate of return is going to be. Number two, advantage, FDIC insurance. So you're not at risk at any level. It is FDIC insured up to the FDIC insurance levels. The third advantage of a CD ladder is it gives you access to your cash on an established frequency. You can establish this over any time frame you want. You know, you may want access to all your money over the course of a year, so you would have a 3-month, a 6-month, a 9-month, and a 12-month CD. You might want longer terms since you like the interest rates, but it gives you access to cash on an established frequency. But there are disadvantages to CD ladders. One of them is the limited liquidity. If you need access to your money and you need it right now, well, you have to wait till that term expires for one of your CDs to get access without forfeiting accrued interest. Now, another disadvantage is that rates could decline or they could increase. You know, if you lock it in at today's rates, rates could decline. And what that means is for that 1-year CD, it's not going to look near as good as that 4-year CD, because when you go to re-up it at the 1 year, rates have declined. You don't get as good of rates. At year 2, rates may have still declined, and you'll forfeit the interest you could have gained if you locked it all up for 4 years. However, rates could also increase. In that case, at that 1 year mark, you're really glad that you're able to re-up it at a higher rate. But those longer term CDs of 2, 3, and 4 years, in this example, well, you're forfeiting those increased interest rates. You know, you're getting decent interest, but compared to higher interest, you know, of course, we would all want the higher interest. And then another disadvantage is certain CDs could be what's called callable. So when you're purchasing CDs, you don't want them to be callable. Callable means that the lender, the actual bank organization offering the CD, could call them and say, that's good. After 3 months on a 4-year CD, pay the interest up through 3 months and then return the rest of your money to you, and you lost that long-term rate. So I recommend non-callable CDs. Now, of course, you can build ladders with treasuries and other bonds or any other fixed income financial instrument, but I wanted to show you for an example on Schwab, they actually have wizards. Now, I know Fidelity has this, many other platforms have it as well, but I thought I would show you a 1-year CD ladder. So I can choose a 1-year CD ladder right here, and I could click on this 1-year ladder. It's a predefined ladder, and I could say, hey, I want to invest $4,000 on this 1-year ladder. My average APY would be 5.53% on it. So I can continue to choose the investments, and it says, hey, for rung 1, here's the ones we recommend. It's new issues, it's CDs. Of course, I could include treasuries, but in this example, I can look at different banks that are new issues. And so I'm going to look at this one and say, hey, I'm going to purchase this one right here. When I look at it, you know, they are non-callable from FDIC insured banks. So I don't know this bank so much, but Schwab has done the research and says I can buy them. Great. So I can continue to the next rung. This is for rung 2. This is for my 6-month ones, 5.45%. I've got 3 options here. I like Bank of America because I recognize them, so I'm going to go with them. And then I'm going to go to the next rung, and here's some other ones that are available. These are my 9-month ones. And so I got 5.5% available from 2 of them. I like Goldman Sachs a lot, so I'm going to choose them. And then I'm going to go to my 12-month one. And Morgan Stanley Bank has 5.5%. Bank of America has 5.5%. Well, I'm going to loan some to Morgan Stanley. You can see I've got them all populated at $1,000 a piece. I can review the ladder. Would I like to roll over this ladder? What does that mean? It says reinvest each rung with a similar investment upon reaching maturity. I'm going to say no to that. I don't want that option. And then I'm going to export this ladder and purchase these. So I can trade each of these, and I have my ladder. So I'm going to trade this ladder. So you can see I click trade. Here it is. I've got $14,000 available to trade. It's a limit order, 3 months. I'm going to review the order and I'm going to place the order. Boom. That one's done. Back to the ladder. Okay. Now I'm going to trade this one. So this is how you actually execute it. I'm buying $1,000 worth. It's 6 months. It's a limit order. Fill or kill it, which means it's either going to do it or not do it. It's going to do it. I place the order. Boom. Back to the ladder. And so I'm just going through each rung of my ladder. Of course, any fixed income specialist at a bank or a trading institution can do this for you. This is just executing what I've set up. I'm clicking place the order. Boom, back to the ladder. And I've got one more to trade. Boom, my buying power is going down by $1,000 per time. And continue and place the order. I now have this ladder fully executed. And so I go back to the ladder, fully done. I can export this ladder to Excel. So I'm going to export that so I have access to it so I can see it. I can go to order status, but I know they won't be executed until later tonight. And so that's how I choose to operate with a CD ladder. And when I do that, well, let me tell you something. I now have fixed rate of 5.53% for my money for the next year. That's going to be the yield on $4,000. Get fired up. Hey, if you have any questions on this, feel free to ask them on whatever platform you're watching. We watch that all the time. Love to answer your questions. We like Schwab. We like Fidelity. There's lots of platforms out there. But I figured I would share this with you. It's a great way to make really decent income on your saved money in a guaranteed FDIC insured way. And we like to provide right now relevant stuff here on the Monday Money Tip podcast. Click the subscribe button if you'd like to receive more helpful information like this. We love to help you win with your money so you can live your fully funded life. Have a great week, everybody.